A lot is changing right now. A new Fed era has begun with Kevin Warsh signaling a completely different direction on rates. And a peace deal with Iran is reshaping energy markets, the inflation outlook, and global risk appetite. Investors are trying to understand all this swirling change in order to know where to invest now. Now, for the last 5 years, the answer was pretty simple. The Magnificent Seven, growth, safety, uncertainty didn't matter. The answer was always the same seven stocks. But that trade is running out of steam. And in the moments like this, when the old playbook stops working, the biggest opportunities tend to show up in places people aren't looking. Right now, I think the best place is small caps, and I'm going to show you exactly why using 100 years of data and the most recent market numbers. Stay with me through the end of this video because I'm going to show you two specific stocks favored by my go-to quant model, plus a simple framework you can use to find more attractive stocks like this on your own. By the way, I'm Steve Reitmeister, but all my friends call me Righty. I've been investing for over 40 years, and I spent most of that time as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen, where I help create a quant rating system to simplify the fundamental research process for stocks, which gives investors greater peace of mind. If you like the idea of looking past the obvious names and finding hidden gems, then go ahead and hit that like button. It tells me that you enjoy this kind of videos, and I should record more like this in the future. Okay, let's start with the big picture. Here is what I'm finding most interesting. Going back the past 100 years, small caps have outperformed large caps by a pretty large measure, 11.8% annually versus 10.3%. I know that doesn't sound a lot, but it's actually a 15% advantage for small cap stocks year after year. What's interesting is that small caps used to have a 20% profit advantage over the larger peers until recently. In particular, over the last 5 years, large caps have enjoyed enormous lead over smaller caps, thus closing some of that gap. We will get back to that in just a minute. Right? So why do small caps win over the long haul? It's not very complicated. Smaller companies are more nimble and more capable to grow earnings faster. And because these stocks get less Wall Street analyst coverage, they're more often mispriced, which means more upside opportunities for investors who know where to look. That's the 100-year case. Now here's where it gets interesting because the last 5 years told a completely different story. Quick side note, this is precisely the type of market insight I regularly share in my live weekly training sessions. It's totally free and includes some of my top stock recommendations. Please join my next one this coming Monday at 7 p.m. Eastern Time. Just register at wallstreetzen.com/live to secure your spot now. Like I said, amazingly, over the last 5 years, the script has been completely flipped. That's because large caps have totally crushed small caps by nearly 3-1. How is that possible? 2 words. Magnificent Seven. Those 7 stocks became the easy button for investors. And here's what made it unusual. They worked in both directions. When times were good and investors wanted growth, the answer was Mag 7. And then when uncertainty crept in and people wanted safety, yep, they clung to the Mag 7 again. That's because nobody wanted to let go of the stocks that had done so well. This wasn't the usual flight to safety into utilities, consumer staples, or healthcare. Again and again, the money just piled into the same 7 stocks. And since the S&P 500 is market cap weighted, it made large caps as a whole look like the place to be. Just to put an exclamation point on this conversation, here's how dominant they were over the last 5 years. The Mag 7 average annual return was 28% a year. Yes, for 5 years in a row. I'm not telling you the Mag 7 is going to collapse. They are riding the AI revolution and enjoying great growth. The problem is that the valuations like PE are getting to nosebleed level, which decreases the odds of future outperformance. Meanwhile, small and mid caps have been left far behind. In fact, the average small cap stock would have to rise about 35% to reach the average PE of their large cap peers. History shows that gap always closes. The question is when. And I think that answer is now. And gladly, there are signs that party has already started. You can see it in the year-to-date numbers. Year-to-date, mid-caps are leading at about 17% gain on the year. Small caps are right behind that at 15%. And then we have large caps. But look at the bottom. The mega caps, where the Mag 7 lives, are only up 3.3%. The rotation is already showing up in the data. The outperformance trend actually goes back to about August of 2025. The good news is that there is still plenty of time to get on board for even more upside. Now, you might be wondering, does this mean that large caps are going to crash? No, I don't think the gap closes that way. I think large caps just kind of tread water from here. They're at reasonable levels for this stage of a bull market as we close in on celebrating the 4-year anniversary. It's not about large caps coming down, it's about these overlooked small cap growth stocks finally getting bid up. That's the setup while far too many folks are still trying to buy the Mag 7 on dips or taking a ride on SpaceX, right? Before I keep going, if you're enjoying this so far, then it's a great moment to subscribe and hit the notification bell. I release timely videos like this often, and these small acts are the best way to ensure you don't miss the next one. Now, I'd be doing you a disservice if I didn't talk about the risks. Small cap investing has real dangers that large cap investing doesn't. First, there's far less quality research available. Now, Apple gets about 200 fresh articles written almost every single day, whereas a stock with like a 500 million market cap may only get a couple articles per week. Even worse, far too many of those articles are AI generated, ranging from useless to actually dangerously wrong, right? Second, small caps are much easier for hedge funds to manipulate. Think about it. A stock beats earnings, rises early on the session, and a hedge fund comes in and pounds it down. You've seen this happen before in your portfolio and scratch your head to why. They can scare investors out and turn, say, a 10% gain into a 15 to 20% loss just from their muscle alone. That is pretty easy to do with a 500 million market cap stock with smaller float, not so easy with large caps, and that's what makes this space so difficult. Third is that they are higher beta. When the market drops 5%, your small cap might be down 10 to 15%. That's uncomfortable, leading to many selling in a panic just before the market bounces and the stock comes back with gusto. To put it simply, small caps are not for the faint of heart. So how can you enjoy the upside of small caps while minimizing the downside? Well, you take the guesswork out. You stop relying on thin coverage and AI-generated noise and focus on the fundamental attractiveness of the firms. That's exactly what the Zen Ratings does. By analyzing 115 unique fundamental factors for every stock, you truly have a complete 360-degree review of a stock's attractiveness. This allows us to do the same type of analysis for under-the-radar small caps as we would for the largest companies like Apple and NVIDIA. When I'm searching for the best small caps, I want them to score a Zen rating of A overall. That puts them in the top 5% of all stocks for their fundamental profile. Then, as I drill down into the 7 component grades for each stock, I focus on the 2 most important, that being top A or B ratings for both growth and financial strength. The A or B for growth puts in the top 20% of all stocks for the consistency of growth. Not just earnings, but also revenue, profit margins, EBITDA, and cash flow. This is the best possible predictor of more growth and more earnings beats to come. Then I want the same A or B for financial strength, which covers 26 different measures that proves it is a well-run company. Now, while component grades like momentum, value, safety, and sentiment still matter, they are secondary to growth and financials. Now, let me put this in perspective and demonstrate the system in action. So to clarify, this is why I'm focused on small caps right now, because 100 years of data says small caps are the outperformers. That means the last 5 years were an oddity, driven by a near obsession with the Mag 7. That party is ending. Not with a crash, but with a rotation back to small caps that have much more attractive valuations. That rotation has already started. Gladly, it's still plenty early to get on board to find the best small caps for serious outperformance. So, moving forward, the framework is simple. Find the most fundamentally sound small caps as proven by the overall Zen rating of A. Then make sure they also have the top 20% of all stocks for both growth and financials. Now on to the 2 small caps that perfectly fit the bill. Now, just remember that investing carries inherent risk. Always do your own due diligence before putting your own hard-earned money to work. All right, first up is UMA with a symbol of OOMA. This is a cloud-based business communications company. They are enjoying strong growth and completely flying under the radar for most investors, which is a big part of the investment appeal. UMA's AirDial product is riding a government-mandated migration away from traditional copper phone lines towards online, a shift that is driving 25% revenue growth year over year. Now, Wall Street analysts are unanimously bullish on the stock, with all those covering with a strong buy recommendation. This includes fair value price targets pointing to serious upside from here. This matches up with the bullish signal coming from the Zen Ratings Quant Review. Here we have an elite A-rated stock, putting it in the top 5% of all stocks reviewed, given its impressive fundamental profile. The component grades that shape the overall rating reveal an A for growth and a B for financial. So already we have a stock that meets my stringent criteria. And beyond that, it also sports A grades for both sentiment and our proprietary AI factor, which points to the most timely stocks. Now, as you can see, I'm just quickly giving you the highlights. But if you want to dig deeper on all this data and all the insight on these stocks, do it on our quote pages for free at WallStreetZen.com. Now, we move on to our second stellar small cap in Bioventus with a symbol of BVS. This is a medical device company under $1 billion in market cap that specializes in joint replacements, bone healing, and hips. The tailwind is simple. Across the globe, there is a huge aging of the population. Demand for the kind of procedures in Bioventus' wheelhouse isn't speculative, it's basic demographic math. The company is perfectly positioned to benefit from the aging of the population that will continue for many years into the future. Here again, we have a top-notch Zen rating of A, which amounts to a strong buy recommendation. It also has a grade for both growth and a B for financials, both of my key areas of interest that I noted earlier. On top of that, it also has an elite A grade for value. That combination of growth and value is rare and super attractive in any investment. Now, you should know that the stock pulled back over the last month. That's not a fundamental problem. The business hasn't changed. It's the kind of welcome dip in a small cap that could present a fresh buying opportunity for those who act now. Nope, I recently shared both of these stocks on my live weekly training sessions. That is where I share my most timely market insights and top stock recommendations. So let that be motivation to attend my next one this coming Monday at 7 p.m. Eastern Time. The best part is when I unveil my trade of the week, combining the best of the Zen ratings with my greater than 40 years of investing experience. So now is a good time to pause the video for a minute and register for free at WallStreetZen.com/live. You'll also find a link in the description below or scan the QR code on your screen. But whatever it takes, I look forward to seeing you on Monday. So what do you think? Are you with me on this rotation to small caps, or are you still a Mag 7 diehard? I want to hear what you have to say, so please share in the comments section below. And if you like the idea of emergent growth, then I urge you to check out my recent video on the best quantum computing stocks.